Hi everyone and welcome back. Today we're going to be going through the process of building out a financial plan for retirement and what that actually looks like. We're going to go through the steps of the fact finder, the actual plan itself, and then what a plan delivery actually looks like. To start off here, we're just going to go through the financial planning questionnaire that our firm uses. So if we jump into the assumptions, so this is the first area where we're going to see psychological reasoning behind responses to this. So your typical plan has assumed life length of 86. We're going to plan though until 95, just in case they do live past the typical age for an individual entering retirement. We're looking at invested assets at 5% return, real estate at a 3% return, and then inflation at 2%. Like I said, this is going to be the first point where we're going to see a psychological response to the fact finder and actually how we look at this and interpret it and then reflect it in the plan. Because planning isn't just about numbers, it's also about how the client or the retiree wishes to see how their plan lays out, but also what they're comfortable with. And that's the big part of this, because retirement is supposed to be comfortable. And if you're not comfortable with your plan, then you're not going to be enjoying your time as much as you might otherwise. So the first psychological response we look for is their expected life length. So if we have a client who's a little bit more, let's say, pessimistic, they're going to be looking at a shorter life length, but then this is also going to affect the rest of the plan, and we've got to take that into account. Does that change the timing of CPP and OAS? Does it change how fast we're drawing down assets? Does it change passing on wealth at different times? It plays a big part into the plan. The largest aspect of this is how to make them, again, feel comfortable drawing down these assets earlier on, how to feel comfortable taking that government money a little earlier than maybe necessarily beneficial for them. The next piece of this psychological information is the invested rate of return. So we have 5%. We think it's a conservative amount. We use this with almost all of our plans unless someone asks for something higher or lower. So we're going to see here if someone's more risk adverse or willing to take risk on. Again, this is going to play into the rest of the plan. So if they're more risk adverse, we're going to look at ways to still reach all of their goals, all of their spending goals, passing on wealth goals, all of that, while taking on less risk as a result as well. And is that possible for them? And the final piece of this first initial question is the inflation. So we've pegged inflation at 2%, and that's historical over the last 20 to 25 years. So if we are looking at a higher percentage, that shows again that they're a little bit more risk adverse. So the next piece of the plan is laying out some financial goals. So this is where we allow any onboarding client to just fill out as much as they'd like. Sometimes it's a lot, sometimes it's just a few sentences, and we know those are the important ones then. So here you again can see we've got a list, an area just to list off some key points and key questions or concerns that they might have for retirement. So the example question we use is, can we purchase a family cottage, and what exactly will that look like? Next, we're going to look at the spending habits now and what their desired spending habits are in retirement. This is again after your debt and mortgage payments and any savings that might occur. So we want to know what you're currently doing and see how that will reflect into what you would desire to do and what the plan actually allows you to do through retirement. Now, the next big psychological question is looking at what age would you like to retire? So we see a lot of the time where people are maybe not as prone to retiring early, where they're enjoying where they're at working and they want to continue doing that. We also see some clients who want to retire as soon as possible, and we take that into account. We try and show them the earliest possible retirement date that they can have based off of the spending that they desire to have throughout retirement. Now, this next part is quite interesting. It's the passing on wealth to the next generation. Again, very psychological question, but it also affects how the numbers play out. So in here, we're going to be able to see if they want to pass any assets on, or if they're wanting just to spend it out incrementally, just year by year. Maybe they're going to do a little gifting here and there, or maybe they have a plan to, pass on the family house when they're passing, pass on some assets earlier on, maybe to help them get into their first home or anything like that. Now we're going to get into the numbers. So this next section is strictly data input. We want to see your income, if that's taxable, if that's not, are you on disability benefits, anything like that, because this again will play out if we're wanting to reach a goal and we're not quite getting there. We need to figure out a way to get there. Does that mean we're saving a little more? Does that mean we're putting money into different savings accounts and anything like that? Here we've got income, and this is going to be for both spouses. We're going to look at, is that taxable? Is it growing on a year-to-year basis? Then we're going to jump into, do you have a work pension plan? Is that going to kick in when you retire, or is it delayed a couple more years? Does it benefit you to work one more year and your pension exponentially grows? Then we look at your net worth and those various accounts you have. So your key ones here are your registered, so your TFSAs, your RRSPs, any spousal RRSP. We're going to look in your work accounts, so any locked in retirement accounts. And then we're going to look at your non-registered accounts, so your investment and your savings accounts. And finally, we like to look at your real estate, because often we'll see clients who have rental properties, and do they plan on holding these properties indefinitely? Do they plan on selling them a little earlier in retirement to help fund further years, or to use that money for other expenses? And finally, here we're going to be looking at the liabilities that a client has. So again, this is more of a psychological point, because we like to see the little things here. So if they've got a high mortgage but a lot of savings, that shows that they're more comfortable with holding this debt, versus some clients where they've got a lot of savings, or maybe even very minimal savings, and they've got no mortgage, showing that they're more against the idea of having this ongoing debt. And the last part of the fact finder is simply just looking at their government benefits, how long they've been working, how long they've lived in Canada, what the maximum benefit is they can receive. Sometimes we'll see clients say that they'd like to start it at 60, versus some say they like to start it at 70. And again, this shows us the psychological point of it, and if they're more comfortable delaying this government benefit rather than they'd like to collect from it as soon as possible. And now we're going to go through the process of actually building a plan out. So we're going to go through the 4 key basic plans that we like to go through, and then typically we'll build out additional plans or adjust them according to what a client would like. So here we've got our default plan. So what exactly is a default? Well, this is just raw data input. So it's not going to take into account a lot of the psychological pieces, but it's going to take into account the actual numbers. And we want to see how this runs out. Why do we do this? Well, we need to have a base in order to work off of this and adjust it accordingly, because again, it's a financial plan. Psychological is important, but a large portion of this is obviously your assets, what you currently are making, how you can grow this throughout time and pass on any wealth later on. Now from here, typical next step would to be looking at CPP and OAS timing. So does it benefit them to delay OAS? Typically we'll try it out at every age to see the numbers. We're also considering the psychological points of if they're comfortable delaying it. So typically we like to delay CPP just because, again, it benefits you to delay it. And then we like to take OAS just at 65 because, again, it's psychological. People are more comfortable taking a bit of the government benefit a little earlier on than delaying everything until 70. The next step in the plan is looking at your RRSPs or your other registered accounts. This is a large portion of actually building out a retirement plan, is how to withdraw those assets tax efficiently. By doing this, we've actually allowed this client to spend an additional $1,000 per year throughout retirement, and this is indexed to inflation, meaning that it's going to grow with inflation. So $1,000 today is going to be quite a bit more 10 years from now. So as you can see, by just playing with the numbers, by just changing the point of withdrawals, by changing the amount of withdrawals, we can actually save someone quite a large amount of money and allow them to, draw down their assets a little differently to benefit them and also benefit anyone else in their life who they'd like to pass on wealth to as well. Now, in this stage of the planning, there are a few things that we really like to look at to make sure that they're actually lining up and they benefit the client as much as possible. And we have to look at a few things here, and that's your effective tax rate and how that's kind of floating through retirement. We're going to look at the tax amount you're actually paying. And also we're going to look at, does your spending increase and not hurt your estate later on in life? So again, if we're looking at Mr. and Mrs. YouTube here, we can jump down to age 86. So when we have their life expectancy at, again, they're spending about $1,000 more per year. And we're going to go over here and click on their estate before tax. So this is the plan we're currently looking at, RRSP Meltdown. And this is the default plan, the initial plan that we built out. So as you can see here, Everything's the same as far as the numbers in there. It's just changing how we're going to withdraw those. So if you look at the RRSP meltdown approach and what that estate looks like, you can see here that the estate after tax is $121,000 in real dollars. So this would be today's purchasing power. In this other default plan over here, the estate is only valued at $111,000. So we're looking at about a $10,000 difference. It's not substantial, but what's really interesting is that in the default plan, we've got a larger amount of assets, but a large tax on estate. Versus in this plan here, we've got a smaller estate value, but no tax on estate, meaning that the money is going to pass on to whoever you'd like it to much faster and honestly just much easier overall, because you're not having to deal with, having to pay taxes for year end or anything like that. The next piece of information we look at when we're building out this part of the plan is their total tax paid. So if we go here, we can look at total tax for this RRSP meltdown. They've got $191,000 throughout their lifetime. Now, if we jump over to this default plan, we're looking at $227,000 throughout their lifetime. So just to recap, in the default plan, we've got a lower estate, more tax, both on death and also throughout the lifetime period. And in the RRSP meltdown, we've got a higher estate and less tax paid throughout their life. Now we're going to look at the final more basic step in this financial planning process, and that's building out a plan that's realistic to follow as far as how they're actually planning on spending money throughout retirement. So we're going to look at the laddered income approach. So in this, we've got the exact same numbers. Everything is identical. The RSP withdrawals are the same. CPP and OAS timing is all the same. The biggest thing we're changing here is the real dollar spending. So the purchase power that they're going to have year over year, we're going to increase it in the first 10 years because this is their go-go years. Then it's going to decrease slightly. And in their slow-go years, finally, we're going to decrease a little bit more again in their no-go years because we're not expecting them to spend nearly as much later in life. Now that you've kind of seen the plan and how it all builds out, we're going to look at the plan delivery and how to actually read these, why we deliver these versus just giving them key points. So this document is actually something we sent out after plan delivery, and again, very similar to the actual software. The numbers itself, they're static, meaning that they don't change when something else is adjusted on the plan. These are just for viewing and kind of those goalposts as I mentioned before. So here you can see their combined view. If we jump over to say Mr. YouTube here, we can jump in and see that, we've got his CPP timing, we've got his OAS timing. It shows the amount of withdrawals we need to do. It kind of shows you what his goalpost should be. So at the end of 2024 here, we've got him with $247,984 in his RSP at that year end. So if it's somewhere near there, that's kind of the goalpost he needs to be aiming for. And that's based off of these withdrawals, along with the rate of return that we have those accounts at. And the same thing goes for Mrs. YouTube here. So again, we've got her CPP timing, we've got her OAS timing, we've got the total predicted amount of tax she'll have to pay. And to wrap up the whole process, included in the delivery is both an executive summary, just to highlight some key points, and also a video to actually go through the documents, just to make sure that you do have an understanding of what your exact plan looks like, and not necessarily just a generic one. So here we're going to highlight some plan assumptions. Again, the year you retire, rate of return, the inflation rates, and then we're going to go and explain a bit of the process a bit more for you here, just so you have an understanding. We're going to show you when to take CPP, how much of CPP you can expect. We'll show you your spending, your key spending here, so go-go, slow-go, and no-go stages. We'll tell you if you need to save anything between now and when your retirement date is. And then we'll show you what a couple years in retirement looks like, as far as, are you withdrawing or are you depositing into some accounts? Sometimes we'll show topping up those TFSAs, and sometimes we'll show needing to withdraw a little bit. So this is where you can see all of that happening. And then finally, we'll outline some key next steps for you, and whether that's going to unlock your Lira to 50% into your RSP, or are you converting your RSP to a RIF next year, Or are you needing to save an extra $6,000 into your TFSA year over year? As you can see, there's a lot of steps in a retirement planning process, and it's not all numbers. It's a lot of the time psychological, because you need to really understand the person and what they're comfortable with. Because again, if you're not comfortable in retirement, then it's gonna be more difficult for you to enjoy your time with your family, with your spouse, with friends, your leisure time, all of that, if you're not really feeling comfortable with how things are going in your financial life. Because again, that can cause a lot of stress. So we're here to help build a plan to reduce that as much as possible.